Hi, this is Bob Brooks, host of the Prudent Money Radio Show. Just got off the air. Talked a little bit today about the two most important numbers to kind of wrap up the retirement series we've been talking about. But the two most important numbers that you need to focus on when it comes to creating the right risk strategy for your investments. The other thing that I started to talk about, we'll finish up tomorrow and finish that as well. But I've been talking about some of the statistics and some of the information coming out of Pop Culture Finance that as the market has had a real tough time the last couple of months, trying to make you feel better by these long-term statistics. I talk about the other side of the story there and why maybe their news shouldn't be so reassuring that everything's going to be fine. But you fix all that with the right Plan B strategy, and that's what we'll be talking about tomorrow as well. For yourself personally, if you've got questions about what your investments are doing, what kind of risk level you're taking as a financial advisor, I'd love to talk to you about it. There's no cost for a phone call or an opinion. So if you want to talk to me about any of that, you can always go to the website at prudentmoney.com. Send us an email at info@prudentmoney.com. We'll get you taken care of. Keep the faith.
This is Alistair Begg of Truth for Life, heard daily and weekends on Bible School Radio, 91.3 KDKR, Decatur, Dallas, Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, what is the most important number when it comes to retirement planning? Today we're going to take a look. Stay tuned for Prudent Money. Afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you'd like to call in and join the program at any point, you're welcome to do so. The number to call is 1-877-913-5357. 1-877-913-5357. You can also go to the website at www.prudentmoney.com. Send a question in to the Q&A that's at the top of the page. You'll see the link, and I'll get that question answered for you. You can also give me your comments. We'd love to hear those as well. That's all at the website, www.prudentmoney.com. And finally, two last things. Make sure that you sign up for the Prudent Money e-letter, and that way you'll get delivered to your inbox right away anything that we put up. And then second, if you ever miss a program, or you want to hear old program we do podcast, and you can go to whatever podcasting platform that you use, your favorite one, and pull Prudent Money up, and we'll be there. So, and you can also go listen to it on the website as well, prudentmoney.com. 1-877-913-5357. Well, we've gone through a retirement series, and I want to kind of just wrap things up by making just a few points, because out of all the things we talked about, and it's interesting because I up until maybe up until the time that I did this particular series, I really would say that all the numbers we talk about, they're all of equal importance. But I got to tell you, there's really, the more that I think about it, there's two main numbers that you really have to know. The first number is, what are you going to shoot for to be your annualized growth rate? So to make that a little bit easier to understand, what growth rate, what kind of percentage rate would your investments need to grow at on an average year by year by year? Now, obviously, you're not going, unless you have something fixed and guaranteed, are you going to get the same growth rate each year? But if you set up a particular strategy that shoots for a growth rate, an investment growth rate on average, that's what we're looking for. And, one of the things that when you start talking about looking at average returns of anything, you want to make sure that you're not talking about a lot of volatility because that kind of messes up the numbers. So we're looking for the average growth rate because that determines a lot of things. Let me put it to you this way in a sequence of different important numbers. Your goals lead to your growth rate, which leads to your expectations, which lead to your risk level. Let me break that down a little. When I say goals, I mean you need a certain amount of money accumulated at a certain age to take out a certain amount each month to live off of and retire in retirement for a certain number of years. So that is really what your goals are, which is the second most important number. What's your expense number? Now, when I talk about expenses, I'm talking about the numbers in the numbers that of monthly cash flow that you need to take care of your expenses. And that's when you figure that up, you're figuring that up in today's dollars. Remember that. Don't worry about inflation and cost of living and that kind of thing. That's something that financial advisors should be able to do for you that runs these kind of programs. But if retirement was today, what do you think you need to live off? Is it $3,000 a month after tax? Is it $4,000? And you always want to use after-tax dollars. Is it $4,000 a month? Is it $5,000? And that is what your main goal is to fund that cash flow for 15, 20, 25 years, just whatever your main goal is. So to get that cash flow goal, you have to have a certain growth rate. You have to average a certain growth rate to keep your investments on target so that you can start taking that money out on a monthly basis. So that's why I say goals lead to growth rate. And then I said lead to expectations. And this is real crucial because if you said, one of the main things that you're wanting to guard against when it comes to risk is to have something happen to where you lose 15 or 20%, and that causes you to want to move your money and change and make big decisions because you've lost temporarily, in most cases, lost that kind of money. You need to be careful with the potential that you could lose 10%, that you could lose up to 15%. And you need to look at I said a little bit about this yesterday, but I want to talk a little bit more about it today. You need to be able to look back and say, if I invested like so, this is the type of losses this particular investment strategy had in the last 15, 20 years, maybe 25 years if you're fortunate enough to see that length of time. So that's what you're looking for. And if you look at it and go, I wouldn't like the fact that my portfolio has a little bit of red in it, a lot of red in it, but I am comfortable with this kind of loss, potential loss. Now, if you had a plan B and a plan A investment strategy, perhaps that you smooth that out and you don't incur those big losses, even though they are temporary. So that's why expectations lead to risk level, and this is an important sequence of numbers that really do act as the engine that runs your retirement goals for you. But when you're looking at those expenses, you want to take a lot of time to consider everything that you spend money on. And that is everything from Christmas gifts to haircuts to toiletries. I mean, just everything that you need to live off of. And that's how you get that number. And the beauty of it is, when it comes to these retirement numbers, you can always change these up and adjust them based on new information. So those are really the two main numbers as we kind of wrap this up that I think that you need to know. What your goals or your cash flow need is, and what's that average growth rate that you are comfortable with and that you expect, that you kind of have an expectation of what could happen, and you have a good feel for the risk level. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Today, we want to just touch base with you on the market for a second. The stock market was up most of the morning and then started to fall again this afternoon, late morning this afternoon, and then was down about a little over 0.5%. Then it rebounded in the last couple of hours and finished what we call flat. Now, when I say the market was flat today, that means that it was either a little bit positive or a little bit negative. In this case, it was just barely a little bit positive. The S&P 500 and the NASDAQ, the Dow Jones Industrial Average was a little bit negative. Pretty typical when you've had the kind of volatility and losses that we've seen the last couple of months in the markets. So really what that's driven by, the exact polar opposite to this morning. We saw interest rates start to fall. Then they picked right back up and finished a pretty good, healthy day for interest rates, which is not what you want to see. The question that I had today was, when do you expect interest rates will start falling again and things start to get back to normal? The problem is, what would the question is, what would it take for that to happen? Really, for that to happen, it would take the Federal Reserve Board cutting interest rates, causing interest rates to fall. And I think that the Fed is going to be very hesitant in doing so, because with that fall in interest rates, starts to kind of inflate that investment bubble again. And the reason I bring that back up is because I just don't believe that 9 months of a very light bear market in 2022 was enough to take all of the toxicity out of the markets, and that includes that big investment bubble we saw build prior to the bear market starting. So, but that's just that's my opinion. A lot of people don't agree with that, but that's just the way that I see it. So the interest rates went back up, and of course the market went back down. So market is really watching interest rates, and of course the Federal Reserve Board says they're going to raise them probably one more time before they cease raising them. But the problem is not, I mean, the good news about it, if they said this was the last one, is that it would be the last one. You're really not going to see any good news until they start to cut rates. So we'll have to wait for that. 1-877-913-5357. This is Bob Brooks. Stick around. I'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, PastorChuck.org. At PastorChuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at PastorChuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, PastorChuck.org.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. Oops, mic slipped out there. Thank you so much for joining me today. You know, I do appreciate it. The number to call if you want to join the program is 1-877-913-5357. Yesterday, I talked about the leading economic indicator, which looks at the economy as a whole, has fallen for 18 consecutive months, which is something that you don't want to see. Brings up two different time periods in our economic history that's happened, 1973 and 2007. And that was led to some pretty significant drops in the stock market. 48% in 1973, in 2007 was 57%. And then you're looking at any time that the economy is, this indicator has dropped more than 4%, historically has always been followed by a U.S. recession. The current drop of the leading economic indicators on a 12-month basis is 8%, double that of kind of the benchmark. And, you know, it's interesting because we've been everybody's been kind of on recession watch and trying to determine when it's going to happen, and nobody really knows. I mean, it's just interesting that it hadn't happened before now. One of the goals that I have with the program is to make sure that you know the other side of the story when you see some of these things, and that you understand how to interpret it. Because this is when, you know, we've had a couple of rough months like we've had. The Pop Culture Finance gets out in rare form and starts printing all kinds of articles, and I call them hand-holding pieces to make people feel better about losing money. This one is entitled, Bear Markets Can Be a Blessing for Those with a Long Investment Horizon. And they go through, and I talked about this yesterday, this is the set of numbers that I want to talk a little bit about today, that they go through some different indicators and what these indicators are saying, and they're all pointing to some pretty big drops in the market and the economy. And the article says, you know, hey, don't worry, no reason for long-term investors to panic because these don't last very long. They tend to be short-lived. It says, since the end of World War II, there have been 12 U.S. recessions. Only 3 of these 12 recessions have lasted at least 12 months, and none has surpassed 18 months. That's all good and everything. I really believe, though, that you are looking at the comparison of apples and oranges. Because if you go back historically, the economy is so much different than the indicators are so much different than they were in the past. So I would be careful with taking a lot of confidence in some of these numbers. And the other thing too is that, you know, I haven't talked about this in a while, but I definitely talked about it in some of the webinars that I've done. Is that everything goes in a cycle, from the economy going from a good to a bad economy, back to a good economy, and same thing, good stock market down to a bad stock market to a good one. And it just depends on where you are on that cycle. Just pretend there's a big circle in front of you and you have it going down to the right-hand side hitting a bottom, going up the left-hand side and repeating. Well, we had an enormous economic expansion, or a good cycle for the economy. And any time that you have that, you have a corresponding, typically, historically, you have a corresponding one that is as big or near the same size. And so that's a pretty big concern that I've got, considering that we've been through that and we haven't seen anything on the bad side of the economy yet, which would be a recession. Now, the length of bear markets, they lean on this one too. It's such much of the same when examining the performance of the stock market over long periods. According to an investment group, Bespoke Investment, the 27 bear markets it defines since September 1929 have lasted an average of 286 calendar days, about 9.5 months. That compares to the 27 bull markets over the same 94-year stretch, which have lasted on average of 3.5 times as long as the average bear market. Now, I got to tell you, this is one of the most, what's the right word? I can't even think of the right word. We'll say misleading. How's that? Misleading statistics in print. That you should feel okay with the market dropping into a bear market as long as this trend continues to go, where there's way more bull markets than there are bear markets. Well, I'm going to give you an example of why that is the case. And it's not because of a good thing. It's because, and let me say this first, and then let you digest it, then we'll go forward. The destruction that bear markets cause in retirement accounts has a much greater effect than the expansion of a bull market and how much gain you get. So here's a good example. Between 2007 and 2009, the stock market that's only 18 months, the stock market lost 14 years worth of growth. 14 years. So it took about 5 or 6 years just to get back to even to where the market was in October. So it takes way more bull markets to keep the market propped up and to make up for losses. Not exactly a particularly a good thing, but Oppenheimer sent out a piece on this, and in fact I don't think Oppenheimer's around anymore. It was an old mutual fund company, if you're not familiar with Oppenheimer, and they said, hey, don't worry, there's more bull markets and more bull market years than bear market years, and same thing. They also talked about how short in duration that these particular the bear markets are on average, with the exception of the last two. Now, I'm not counting COVID, because that drop in COVID to me was more of a crash than a bear market. We can discuss the particulars of that, but that's the way that I would analyze it, because it didn't carry out more than a couple of months, which is a crash to me. And the structure of the way the market fell as well. Now, bear markets are set up to be a lot longer in number of months or years. But the last two bear markets that we went through, the technology one was about 29 months, and the financial crisis was about 17 months. And so I think that if you look at the environment and everything, I think that you could make a case for bear markets may last longer than average Of course, that wasn't the case last year, which kind of kills my theory. But anyway, just something to keep in mind. I guess the thing that you want to keep in mind is the results from this next study, which is it's very interesting. Because number one, I found it to be wrong, and I'll tell you why in a second. But and then why these big statistical studies cover up these real big risks that don't come out because you're focusing on the long term. But it says, no study drives home the importance of optimism and patience more than Cressmont's research's annually updated data set. Basically, they said if you go all the way back to 1900 and you look at what's called rolling 20 years, which is you're basically starting that first year in 1900 and you're starting a 20-year period from each month going forward. It's a very complicated process. But anyway, the bottom line is from 1919 to 2022, there has never been a 20-year stretch of returns that has ever been negative. So what this article was stating was that the 20 years, as long as you're an investor for 20 years, you won't lose money. They call it Wall Street's guarantee. We'll talk more about this tomorrow, because I think this is a good point to be made. Hey, this is Bob Brooks. You are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website at prudentmoney.com. Send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.